Welcome to Topic 6, Statement of Cash Flows, Part 4. In the Part 4 video, we're going to prepare a simple statement of cash flows from a list of items. So here you can see the question that we're working with. Hannah Louisa had the following transactions for the month for her delivery business. So it's our job now to prepare a statement of cash flows for the month of June using the following transactions. So you'll have been provided with a handout that you'll be able to use to fill out this question as we work through it. So just know, in addition to covering the new work from Topic 6, we're also going to be reviewing transaction analysis that you covered in depth in Topic 3. So moving on to working a cash flow problem, the first question that you need to ask yourself is it a cash transaction? So in other words, has cash been received or has cash been paid? If your answer is a no, keep it away from the cash flow statement. We don't want it anywhere near there, because if it's not cash, it's not a part of the cash flow statement. It doesn't belong there. If, however, your answer is a yes, then what you need to determine is, firstly, do I classify it as operating, investing, or financing? Okay, so we know from our transaction analysis that every transaction has at least two effects. Okay, two effects, two accounts. Okay, two things are happening in any given transaction, minimum of two. So when it comes to cash flow statements, for a transaction to be part of that cash flow statement, one of your effects must be cash. Okay, if it's not cash, then again, it shouldn't be anywhere near your cash flow statement. But let's assume it's a yes. So one of our effects is cash. Your second effect, so your second account, that's the one that's going to help guide you as to whether we're working with operating, investing, or financing activities. So remember, as we've covered in earlier videos in Topic 6, operating activities, we're looking for current assets, current liabilities, revenues and expenses. Investing activities, we're looking at non-current assets. And for financing, we're looking at non-current liabilities and our equity accounts. So once we've got our item classified, then we work out, is it an inflow or is it an outflow? So now we're going to jump across to the handouts, where we'll go through each of those transactions in depth, and we're going to identify them as either operating, investing, or financing, and whether or not they are positive or negative in terms of are they an inflow or are they an outflow. Okay, so now we've moved across to the handout that you've got for Hannah Louise and all of her transactions. So you can see here that we've got a table with multiple columns. So in the first column you can see we've got this month's transactions listed here. Then we have a column for transaction analysis. So what we'll be doing in this column is we'll be identifying our minimum two effects or two accounts identified in each transaction. So just note here for expenses that with our expenses they do increase, but the impact on owner's equity is that owner's equity does decrease. Okay, because whilst when we incur an expense and that expense goes up, expenses decrease owner's equity. That's their ultimate effect. Next column we have the net cash flow. So what's the amount? Next column we have operating, investing, or financing. So that's where we're going to classify it. And then next we have the profit. We're going to calculate profit. So initially it'll be what is the effect on profit, if any. And then at the very bottom of the screen you can see we'll actually be calculating profit and also total net cash flows. So starting off, we have on June the 1st, the owner invested $50,000 cash and a delivery vehicle worth $25,000 in the business. So our two effects, we've got to spot two things. Well, we can see the word cash here. That's a nice easy one. So the owner's investing the cash into our business. So that means our cash is going to increase. So we have an increase in cash of $50,000. Second effect, what would be a second thing that's happened here? So we have a delivery vehicle as well that has been mentioned. So the owner's invested not just cash, but also a delivery vehicle, or we could say a motor vehicle. So a motor vehicle of $25,000. Now the owner's the one who's investing these items in there, so our third effect that's going to happen here is going to be capital. Oops, I put that in wrong. So let's go increase in capital of $75,000 $50,000. So that's the total amount. So if you also think back to your accounting equation, you've got your assets on the left, 50,000 plus 25,000, plus liabilities and owner's equity on the right. So capital of 75,000, which would be on the right-hand side. So our accounting equation is balancing out here as well. So working out our net cash flow. So again, this is the cash part. Okay, increase in cash of $50,000. So that means we're going to have positive $50,000 cash flow. Is it operating? Is it investing? Is it financing? Well, the owner is the one that has invested this cash. So that means we're dealing with equity. Okay, so our increase in capital. So that will give us a financing activity. Or we can classify it as a financing activity. Okay, so as I was saying in the previous, the start of this video, that you know you've got your minimum two effects. One of those effects should be cash in order for it to get to a cash flow statement in the first place. Your second effect is what helps you to classify it. Okay, so here it's capital, which we know is part of equity, so we know it's going to be a financing activity. In terms of profit, well, we know that profits, in order for profit to be affected, we need a revenue or an expense. So we don't have any revenues or expenses, so there's no effect on profit here. So moving now to June the 2nd, we paid rent for June of $600. So firstly, is cash involved here? That's always our first question. Well, we've got the word paid, so paid rent. So when you see the word paid, you can safely assume that that is the same thing as cash. Okay, whether we paid by check or whether we paid, say, by EFTPOS or paid in cash. You see the word paid, you can assume that we have got cash involved here. So if we're paying cash, it means cash is leaving us, it's leaving our account. So we're going to have a decrease in cash of $600. So we know we've got two effects. So what's our number two? Well, we're paying the rent. Okay, so paid rent, and rent is an expense we are incurring. So when we incur an expense, that means that expense is going to increase. And that's it. So that's our two effects. So our net cash flow, so we're after the cash component, and decrease in cash, which means a negative 600. Look to your second item so that you can classify. So we have an expense item here, which makes it an operating activity. Effect on profit, well, expenses reduce our profit. If you think back to your calculation, profit equals revenue minus expenses. So expenses pull profit down. June the 3rd, we purchased office equipment for $20,000 in cash. So cash, when the word cash is there, you know straight away cash is involved. This is something for our cash flow statement. So we purchased the office equipment, so that's indicating that our cash is decreasing. It's a cash outflow. Our second item here, what did we buy? Well, we purchased office equipment. So when we buy office equipment, that means we get more of the office equipment. Oops, what did I do? I pushed something wrong. So we increase office equipment by $20,000. So our net cash flow, so again, we're after the effect that has cash in it. So cash is decreasing by $20,000. So minus 20,000. Now office equipment, so that's what's going to help us classify this cash flow. So office equipment is a non-current asset. So non-current assets we know belong in our investing activities. Impact on profit, well, are we dealing with an expense? Are we dealing with a revenue? No, we're not. So that means we have no effect on profit. On June the 4th, we paid 6 months insurance. So again, we've got that word paid in there. So that's indicating that we have got cash involved. So we're paying for something, means our cash is going to go down by $300 in this case. So our second effect, well, we're purchasing insurance, but we're purchasing 6 months of insurance. So that's different to just paying for an expense. We're paying for 6 months insurance up front. So that means we're dealing with a prepaid asset or prepaid expense. So increase prepaid insurance for $300. So that prepaid insurance, just bear in mind that that is a current asset account. Our net cash flow. So again, we're after the impact on cash. So cash is decreasing by $300. So minus 300. Our prepaid insurance, as I said, that's a current asset. So a current asset means we're dealing with operating activities. Do we have an impact on profit? Well, are we dealing with a revenue or an expense? No, we're not. June 8, we purchased office supplies on credit. Okay, so we're buying something on credit this time. So if we purchase something on credit, means we haven't paid for it yet. So it becomes a payable. So here what's happening is we're going to increase accounts payable for the amount of $1,000. And we're purchasing office supplies. So that's our second item. So if we buy office supplies, it means we're acquiring more office supplies. So it's also going to increase by $1,000. Do we have a net cash flow? Well, to determine that, can you see cash sitting in either of these? Okay, no cash there, no cash there. So no, we're not even dealing with the cash flow here, so it's not going to go to our cash flow statement. Do we have any impact on profit? No, we're not dealing with any revenue or expense items either. Moving on to June 10, we received $1,450 revenue in cash for delivery services. So we're receiving cash. So it means we're going to have an increase in cash, the amount $1,450. And our number 2, remember, we're always looking for our second effect, our second item. It's revenue. Okay, we received cash for revenues. So we can write increase revenue for $1,450. So our net cash flow, so again, you're after the effect that has got cash in it. So we have an increase in cash, so our net cash flow is going to be a plus $1,450. In terms of operating, investing, or financing, we'll always look to your number 2. Okay, so we know cash is 1. What's our number 2 that's going to help us classify? So we're dealing with revenues. So where we have a revenue involved, we're dealing with an operating activity. Do we have an effect on profit? We know revenues and expenses impact our profit. We have a revenue here. So profit will go up by $1,450. Next, on the 12th of June, we billed a customer for $2,500 for delivery service provided. So when we bill a customer for money, it means we've done work for them, but we haven't been paid for it yet. So that means we have an increase in accounts receivable. We've done work, or essentially we've done work on credit. So a customer now becomes an accounts receivable and they owe us money, so they become a current asset. So we billed them for delivery service provided. So delivery services, so that's what we're in the business for, so that's our revenues. So we also have an increase in revenue. Oop, and I left out the amount, excuse me, I'll just put that in, $2,500. Net cash flows, well, the word cash is not sitting in here anywhere. So no cash flow. So we don't need to classify as operating, investing, or financing. Do we have an impact on profit? Yes, we do, because we are dealing with a revenue account. So our profit is going to increase by $2,500. So remember that your profit calculation is different to your cash flows. Okay, profits, revenues earned less expenses incurred. Whereas cash flows is purely just about the cash flow. On June 20, the owner withdrew $600 for personal use. So they withdrew cash, or withdrew $600. So that indicates, one, cash is involved here. So we have a decrease in cash of $600, and it's the owner. The owner is the one taking it out. So that means capital comes into play here. So when the owner takes out their money, we have a decrease in capital, because capital represents what the business owes the owner. So when the owner takes some of their money out, it means the business doesn't owe the owner as much, which is why we have the decrease in capital. Now in terms of cash flows, we're after that effect that has cash involved. So decrease in cash means we're going to have minus $600. Operating, investing or financing. So again, look to your second item to help you classify. We have a capital account here. So capital account, which is part of equity. Equity means we're working with a financing activity. Profit calculation, are we dealing with a revenue or an expense? No, we're not. So there are no implications for profit here. On the 20th of June, we also received $1,000 for 4 deliveries. So we received $1,000. In other words, we received cash. So we'll have an increase in cash of $1,000, and we received that money for 4 deliveries. We're a delivery business, so that's our revenue. So we've also got increase in revenue of $1,000. Our cash flow, again, with our 2 effects here, we want the one that has actually got cash in it, because that represents the cash flow. We have an increase in cash, so that means our cash flow is plus $1,000. Look to your second effect to help you classify. It's a revenue account. Revenues belong in our operating activities. Profit implications. Where are we? Profit implications. Yes, again, revenue account. So profit is going to increase by $1,000. On the 21st, we purchased a laptop on credit for $200. So again, we purchased something on credit, means we've got the goods, we have not paid for it yet. So we are going to owe money to an external party. So we'll have an increase in our accounts payable for $200. And we purchased a laptop. So we're not going to have an account here called laptop. What we're going to do here is we're going to say increase in equipment, $200. Now you might call it office equipment. You might have a slight variation on it, and that's fine, as long as you're not saying increase laptop, because we wouldn't have a specific account called laptop. In terms of cash flow, can't see anything in here that says cash, so we have no cash flow. So we don't have to classify it. Implications for profit, we're looking for a revenue or an expense account. We don't have a revenue or an expense account here, so no implications for profit. On the 24th of June, we received $1,000 from a customer in payment of account. So again, we see that word received, we've got $1,000 straight after it. That means we're receiving cash, so we can increase cash, $1,000. And we received it from a customer. So in other words, from an accounts receivable. So it was from a customer in payment of their account. So that's also what tells us it's an accounts receivable, because they previously owed money to us. So we're going to have a decrease in accounts receivable of $1,000. Okay, because they don't owe us that much money anymore, if at all. Our cash flow, again, we're after the effect with cash in it. We have increased cash. So So plus $1,000 is our cash flow. Look to that second item again to help you classify it. So accounts receivable, current asset. Current assets are associated with our operating activities. Impact on profit, well, we're not dealing with a revenue or an expense account here, so we don't have any effect on profit. Next, we paid our assistants wages. So we've got the word paid in there, which is indicating that we did pay cash. So we will have a decrease in cash of $400. Look for your second item. Well, what is it we're paying? We're paying the assistant's wages. So what we'll have here is an increase in wages expense, okay, for $400. That's our number 2. So in terms of our cash flow, again, we're after that effect with cash in it. It says decrease cash, so minus cash, 400. Classify, look to your second item, wages expense. So expense accounts are associated with our operating activities. Implications for profit, we're dealing, excuse me, just had to sneeze. We're dealing with an expense account. We know that profit is revenue less expenses, so the effect on profit is going to be minus $400. And lastly, we paid $300 advertising expense. So paid, again, that's indicating that cash is involved, and cash is going to decrease, again, where it's a payment, so it indicates an outflow. So it's 300. And our number 2 is we're paying advertising expense. So we're paying an expense here. So what happens is we'll have an increase in advertising expense because we're incurring the expense. Previously we didn't have the expense, now we have the expense. That's why it's gone up. The cash flow, again, look for the item that's actually got cash in it. Decrease cash, so we minus cash, $300. Classify, look to your second item. Increase advertising expense. So the expense, as we know, is associated with operating activities. And our effect on profit, well, again, we're dealing with an expense here. Expenses pull our profits down. So we'll have an effect of minus $300. So we've gone through all the transactions here and we've classified them. And we've identified our 2 effects, we've identified the cash flow, we've classified the cash flow and also the implications for profit. So now what we want to do is calculate profit. So what you need to do here is you would go through and add up all of your revenue items. So your revenue items are the pluses. Okay, plus you can also match that across here as well. Okay, revenue item. I'm going to do a little bit of a highlight. It's a revenue item. Here we also have a revenue item on the 12th, another revenue item. All right, and another revenue item. So add 1,450, 2,500 and $1,000 together. So that should give you $4,950 in revenues. And from there you can subtract off your expenses. So we have the rent expense of $600. Then you have your wages expense of $400. And then your advertising expense. Oops, and I did leave that 400, oh, 300 out of there. Okay, so subtract off that money. So you're subtracting off $1,300 in expenses. So in total, what we should have is $3,650. Okay, so that equals the revenue minus your expenses. Okay, and that's profit. So next step, we'll calculate our total net cash flows. So here you want to take all of your positives. So if I clear that now, none. Got net cash flow, we want our positives, 50,000 plus your 1,450. 1,450 plus $1,000 plus $1,000. Okay, so you'll have $53,450, and from that subtract all of your cash outflows. So that will be 600 minus 20,000 minus 300 minus 600 minus 400 and minus $300. So add up all of those blue items. So we got 20,000. So what's that? 100. In total, we should have a positive figure of $31,250. So just do bear in mind with this column, you can get a negative figure overall. If you get a negative figure overall, it just means that you have a cash outflow overall. So here we have a cash inflow overall as well. Okay, and you'll see this figure also match up on the cash flow statement that we'll now be moving on to prepare. So now that we've completed our practical example, so we've gone through all of those transactions and we've identified, is it a cash transaction or not? Is it operating? Is it investing? Is it financing? Is it an inflow or an outflow? What we can do now is we can start to construct our cash flow statement. So the first part of our cash flow statement is our operating activities. So the direct method of calculation is what we use for our operating activities. So it shows clearly our inflows and our outflows, so our cash inflows and our cash outflows as well. So the items that are typically included in this section are as follows. We have our cash receipts from customers. So these guys will always be displayed as an operating inflow. So all the items that in your practical example in the table that you've got there that you classified as operating and that are positive, you'd add them together and they form your cash receipts from customers. The second item that you'll see there are your cash payments to suppliers and employees. So again, all the items that you classified as operating and that are negatives, with the exception of interest and income tax, all the rest you'll add them together and they form your cash payments to suppliers and employees. And the reason we don't add in interest and income tax is because they have their own separate line items. If you're wondering why, that just comes back to our accounting standards. So our accounting standards do state that interest and income tax paid must be disclosed separately to cash payments to suppliers and employees. So some points down the bottom there to note. Inflows are positives and your outflows are negatives in a cash flow statement. So with those outflows being negatives, you want to put them in brackets, just so you're really clear that you are subtracting them away. Because in cash flow statements, we're not really writing less or minus or subtract. The brackets tell us that that's what's due to happen. All right, so try and just get into a habit of using brackets for negatives. So now moving on to the cash flow statement itself. So you can see up the top there, we have our cash flow from operating activities, your first line item, cash receipts from customers. So again, referring back to your table, all those items that we classified as operating, all the positives, we add them together, we get $3,450. Second line item there, our cash payments to suppliers and employees. So here we're adding up all of those items, those transactions that we classified as operating. And we want the outflows though. The outflows, and just double checking that we don't have any income tax paid or any interest paid there, because we wouldn't actually add those in here. So we don't have any of those. So we don't have anything else to add into this section. So our cash payments to suppliers and employees come to $1,600. Have a look, see we've got the negatives in there, which show that it's an outflow. And it also means we're going to subtract it on this statement as well. So in total, our net cash provided by our operating activities comes to $1,850. And that figure is simply your cash receipts from your customers minus your cash payments to your suppliers and your employees. Also take a note of the wording for that total where it says net cash provided by operating activities. So we use the words provided by when we have a positive figure for a particular category. And you'll see further down when we get to it that the wording can change to used in. So I'll explain that in a second when we get to it. Now looking at our cash flows from our investing activities. We just had the one item here from our table that we classified as an investing activity, and that was the purchase of the office equipment. Total, $20,000. And it's in brackets, okay? Notice it's in brackets, it's representing an outflow. Okay, when we purchase something, we have cash flowing away from us in order to make that purchase. So the only item we've got, so total net cash used in investing activities is $20,000. So note, we still keep the brackets there. We're still dealing with an outflow overall. So when we have an inflow overall, we have a positive figure, we use the wording net cash provided. But when we have an outflow overall, we want to use the wording net cash used in. Okay, very subtle difference, but they do mean two very different things. Now we move on to cash flows from financing activities. So this is everything in that table that we labelled financing. So we've got two items here. We have our proceeds from capital contributed. So proceeds, that represents an inflow because we're getting the proceeds from capital being contributed to us. So $50,000 was our figure. And then we also had a payment of drawings. So drawings being an outflow because it means the owner is taking money out of the business. Okay, so outflow. So we want those brackets in there as well to signify that this is an outflow. So they're the only two items that we'd classified as financing. So net cash provided by financing activities, positive figure, $49,400. So now that we've got all of our items into our cash flow statement, we've totaled up each of our categories here. Our next step in the cash flow statement is to determine what's the net increase in cash and cash equivalents held. So what we're going to do is take each of those three totals and we're going to add them together. So we take $1,850, we subtract $20,000, and then we add $49,400. And the figure that gives us is a positive figure of $31,250. So we can say that's a net increase in cash and cash equivalents held. Now be aware, you can actually get a negative figure here. And if you get a negative figure here from combining those three totals together, we call that a net decrease in cash held. Okay, so again, just small difference, but does mean two very different things. Our next step from here, we take our cash and cash equivalents at the beginning of the month. So that's the balance of our cash and cash equivalents here. She just started the business. So there is no balance of cash at the beginning of the year, beginning of the month. Next step, to get to our cash and cash equivalents at the end of the month, what we want to do is we take that net increase just here and we add it to our cash and cash equivalents at the beginning of the month to get to our cash and cash equivalents at the end of the month. So you really want to be performing a calculation here. So in this case, we get to $31,250. So in reality, as well, you would be comparing that cash at the end of the month back to your balance sheet, and you would look at the ending balances of your cash and cash equivalents in the balance sheet, and those two figures should actually match up. So this is like a little bit of a check figure at the end here. Okay, it's not something that we're going to be making you do in this course, but I think it's just good for you to be aware of that information. Okay, it's just a little check figure at the bottom. We can match it back to our balance sheet, and again, make sure everything's balancing out so we know we hopefully don't have any errors happening in there. So that concludes the practical example now. So the next video is going to go through how we can interpret our cash flow statement.